2025 was the first post-halving year in Bitcoin's history that finished negative, about 6% down on the year. The 4-year cycle did not behave the way the textbooks promised. The reason is simple. The textbooks were written before the ETFs. The asset has changed. Most of the playbooks have not. I'm Rachel from ChainSense. In the next 10 minutes, sizing before timing, wrappers before ideology, and drawdown profiles before the drawdown. The cycle theory was a closed system theory. New supply halved every 4 years, demand stayed roughly steady, price discovered itself. That worked until January 2024. The asset opened up. The model never updated. That month, the United States approved 11 spot Bitcoin ETFs on the same day. Institutional flows that had never been able to touch the asset suddenly could. Pension funds, endowments, wealth managers. The largest spot Bitcoin ETF now holds more Bitcoin than any single public company. The fourth halving still happened on schedule in April 2024. Block subsidy cut from 6.25 Bitcoin down to 3.125. But annual supply growth is now below 1%, small enough that demand timing dominates supply timing. Halving makes the supply. Wall Street sets the price. The cycle is not dead. It is just diluted by flows that did not exist 3 years ago. Most retail investors think the only Bitcoin decision is buy or wait. There are 5. And market timing is not on the list. Bitcoin in 2026 is not a market timing problem. It is an ownership problem. Decision 1. Allocation. How much you actually hold relative to your total wealth. Decision 2. Wrapper. ETF inside a tax-advantaged account, direct ownership outside, or both. Decision 3. Entry. DCA, lump sum, or scaled in by drawdown. Decision 4. Custody. Exchange, hardware wallet, or multi-sig. Decision 5. Tax. Taxable account, ISA, IRA, or treaty-protected wrapper. Each decision compounds with the others. Get 4 right and 1 wrong. And the wrong one usually decides your outcome. I have watched investors with perfect allocation lose half their position to an exchange collapse. I have watched investors with brilliant entry timing hand 40% of their gain back to the tax authority on something a tax wrapper would have sheltered entirely. I have watched investors with the right wrapper sit on the wrong custody and lose the position to a phishing email they almost did not click. The decision you skip is the decision that costs you the most. The 5-decision framework is the rest of this video. 3 tiers. Conservative, 1 to 5% of liquid net worth. Balanced, 5 to 15%. Aggressive, 15 to 30%. Pick the tier you can hold through a 60% drawdown without selling, not the tier that maximizes upside on a spreadsheet. The tier you can actually hold when the asset cuts in half, and then sits there for 18 months while the headlines tell you it is over. Here's the contrast that decides most retail outcomes. Investor A holds $25,000 of Bitcoin against $500,000 of total wealth. That is 5%. Investor B holds $150,000 against the same 500. That is 30%. Same Bitcoin drawdown, 60%. Investor A loses 3% of total wealth. Investor B loses 18%. Investor A keeps composure through the drawdown. Investor B sells the bottom and never re-enters the position. Different sizing, different lifetime outcome on the exact same asset. Sizing is not conviction, it is behavioral honesty. Wrapper. The ETF gives you price exposure inside a tax-advantaged account. Direct ownership gives you Bitcoin you actually hold. Most people who care deeply about self-custody do not have a Roth IRA full of an ETF. And they should. Inside a Roth IRA in 2026, every dollar of Bitcoin appreciation is tax-free in retirement. The contribution limit is $7,500. Modest. Compounding for 30 years on a volatile asset, not modest. In the UK, the wrapper applies to LSE-listed Bitcoin ETPs, not direct Bitcoin. Since October 2025, retail investors have been able to hold regulated Bitcoin ETPs in an ISA. Direct Bitcoin still cannot live inside an ISA wrapper. Account structure decides, ideology does not. Entry. DCA is not a price strategy. It is a discipline. Bitcoin's volatility means lump sum is statistically right about half the time, and DCA right the other half. The behavioral value of DCA is that you never have to decide. You set it, you stop watching. That alone usually outweighs the small expected value cost. Custody. 3 thresholds. Below $1,000. An exchange is the appropriate trade-off. The cost of a hardware wallet is meaningful relative to the position size. Above 1,000, move it to a hardware wallet. Above 30,000, add a metal seed backup that survives fire, flood, and time. Above 200,000, start considering multi-sig. Bitcoin sitting on an exchange is Bitcoin you do not own. The exchange survives until it does not, and the people who lose everything were comfortable 5 minutes before. Tax. A UK ISA holding a Bitcoin ETP or a US Roth IRA holding the same can be worth 20 to 30 percentage points in after-tax return advantage over a multi-decade horizon. 20 to 30 points. That is larger than almost any market timing edge you will ever capture. In the 2026-27 UK tax year, the ISA allowance is £20,000. The capital gains allowance outside the ISA is just £3,000. The wrapper is not a tax trick, it is a decade multiplier. Volatility has compressed compared to previous cycles, but it has not disappeared. What changed is the shape of the drawdown, not its existence. 3 profiles to plan for. Macro-driven drawdown, 30 to 40%. The Fed surprises, equities sell off, Bitcoin sells off harder. ETF flow reversal drawdown, 40 to 60%. The institutional bid pauses, leverage unwinds, and marginal price discovery cuts both ways now. Crisis drawdown, 60% or more. A black swan event, a major exchange failure, a sovereign-level reaction. One of these will probably happen in the next 3 years. Sizing for the drawdown you can survive means picking which one breaks you, and not exceeding it. Drawdown is not risk. Drawdown is the price of admission to long-term Bitcoin exposure. The investor who sizes correctly for behavioral reality, picks the right wrapper for the account structure they actually have, sets up DCA they never have to think about, custodies above the threshold, and uses tax-advantage structures wherever those exist. That investor does not need to time the cycle. The investor who skips any one of those holds a position the market can take from them in a single quarter. The cycle is not dead. It is just diluted by ETF flows that did not exist 3 years ago. Supply still halves on schedule. Demand now sets the calendar. Bitcoin in 2026 is not about market timing. It is about owning it well enough to still own it in 2030. Bitcoin isn't timing. It's sizing. Size for the drawdown you can survive. The 6 satellite videos go deeper on each piece. 1 topic per video. Links in the description. Subscribe to ChainSense. I'm Rachel. See you in the next one.